This morning I pulled up the chart and sat there for a full minute before I started typing. Because what I am looking at right now is not a signal, it is a verdict. Surprised. The gold to silver ratio just broke through a level that has held for over a decade, and the last time this structure failed, silver moved more than 300% in under 18 months. I have been watching this setup develop for 3 years. I have mentioned pieces of it in previous videos. But today everything converged in a single chart pattern that makes the complete picture impossible to ignore any longer. Excited. Let me walk you through exactly what happened this morning, why it matters more than anything else moving in this market right now, and what the math says comes next. Gold is trading at $5,132. Silver is trading at $86. That gives you a ratio of approximately 59.9. 59 ounces of silver to buy 1 ounce of gold. That number is the most important number in the precious metals market right now. Not the price of gold, not the price of silver, the relationship between the two. Here is why that relationship is everything. Every major precious metals bull cycle in the past century has followed the same sequence. Gold moves first. Institutions and central banks drive the early phase. Safe haven capital flows into gold because gold has the reserve asset designation, the sovereign bid, the balance sheet credibility. Silver lags. It always lags in the early phase. And then something shifts. The ratio reaches a threshold, the physical market tightens, the speculative capital that was sitting in gold starts looking for the next asymmetric move, and it finds silver. When that rotation begins, it does not happen slowly. It compresses violently. The ratio collapses, and silver outperforms gold by multiples within a single cycle leg. That rotation has not happened yet in this bull market. Gold has gone from $2,000 to over $5,000. Silver has had a significant move as well, from around $20 to a peak above $120, but gold led the entire way. The ratio confirms it. We are still in the early phase structure where gold dominates, and that means the silver outperformance phase, the phase that has followed every gold-led bull run in modern history, is still entirely ahead of us. The chart I want you to pull up is the weekly gold to silver ratio going back to 2008. What you will see when you look at that chart is a structure that has been building for 15 years and is now reaching its conclusion. In 2011, the ratio hit a cycle low of approximately 32. Silver was trading near $49. Gold was being outrun. That was the last time in recent history that silver truly led this market. Then the ratio climbed for the next 9 years as gold held its ground more effectively through a difficult environment for both metals. The ratio peaked in March of 2020 at approximately 125. That was the liquidity panic. Everything was being sold, and silver, being the more industrial and less monetarily designated of the two metals, got crushed harder. At that extreme, 125 ounces of silver could not even buy 1 ounce of gold. The dislocation was historic. Since that 2020 peak, the ratio has been declining. Lower highs, lower lows, a descending channel that has been intact for 5 years. And within that channel, a second structure has been forming. If you draw the ascending support line connecting the major lows from 2011 forward, and then overlay the descending resistance line from the 2020 peak, those two lines are converging right now. They are meeting at a single point on the chart. The range between them has compressed to roughly 55 on the low end and 65 on the high end, and the ratio at 59 is sitting directly inside that compression zone today. Two multi-decade trend lines meeting at a single point while the ratio sits between them is not a casual observation. It is a coiled spring. Price compressed between converging structures cannot stay compressed indefinitely. It breaks. And the direction of the break in this case is being telegraphed by every piece of supporting data in the market. Let me show you the math that translates this chart setup into price targets. My first gold target is $6,000. Gold has been advancing in consistent increments throughout this bull cycle. The pattern has been reliable and repeatable. Multiple legs of similar magnitude have already completed. A move from current levels following the same pattern arrives cleanly at $6,000. That is not projection. It is extrapolation from a pattern with a strong track record. If gold reaches $6,000 and the ratio contracts to 40, which is the prior major support zone that held across multiple years and multiple market conditions in the 2010 through 2012 period, then $6,000 divided by 40 gives you $150 silver. $150 silver from $86 today is a 74% move. That is the conservative first target, the one that uses the most cautious ratio assumption and the most modest gold projection. The second calculation uses a higher gold target of $7,000. If gold makes two consecutive advances from current levels following the same pattern that has already repeated multiple times in this bull run, it arrives in the $7,000 range. And if the ratio compresses to 25, a level it has reached in every major silver bull cycle of the past 50 years, then $7,000 divided by 25 equals $280 for silver. $280 silver from $86 today is a more than threefold increase. And that is not the upside case. That is the moderate case using historical ratio lows. The upside case, if gold overshoots to $8,000 or $9,000 driven by sovereign debt stress, dollar devaluation acceleration, or a regional conflict escalation, puts silver in the $320 to $360 range using the same ratio arithmetic. I am not going to anchor hard to that number, but I am also not going to pretend the math does not produce it, because it does. Now I want to give you the physical market data that turns this from a chart thesis into something with real structural backing. COMEX silver deliveries are at historic levels. The 12-month average is running at approximately 43 million ounces per month. Monthly spikes are reaching 75 to 80 million ounces. These are numbers the market has not seen in nearly 2 decades of recorded data. At the same time, COMEX registered silver, the physical metal actually available for delivery, has fallen to approximately 81 million ounces. Registered inventory is the metal that backs the paper positions. It is the physical foundation of the entire future structure. Against that 81 million ounces of physical backing, the open interest on the exchange currently represents approximately 294 million ounces of paper claims. That is a paper-to-physical ratio of 3.6 to 1. For every ounce that can actually be delivered, there are 3.6 ounces of claims outstanding. That imbalance is not a footnote. It is the fault line running underneath the entire market. Here is the mechanism that connects that data to the ratio. Every ounce of silver taken out of COMEX through physical delivery leaves the exchange permanently. It goes into private hands. It is no longer available to be leased, lent, or used as collateral to support short positions. The short sellers on COMEX depend on access to physical inventory to maintain their positions. When that inventory is being pulled out at record pace month after month, the structural support beneath the short book is being quietly removed. The commercial short sellers in this market are not ignoring this. The data shows that the 4 largest short holders in the COMEX silver market have collectively reduced their combined positions by nearly half since 2024. That is not a coincidence. That is informed repositioning. These are the participants who can see the registered inventory numbers in real time. They understand what a 3.6 to 1 paper-to-physical ratio means when deliveries are running at record levels. They are covering because they can read the data and the data tells them where this ends. Meanwhile, major institutions have been taking silver and gold deliveries at a pace that tells its own story. JP Morgan alone took 3 million ounces in a single month earlier this year. The institutions that built the paper-short infrastructure are now pulling physical metal out of it. That is the institutional confirmation that the chart and the physical data are pointing in the same direction. I want to give the bear argument a fair hearing rather than simply dismissing it. The first counter-argument is the supply-response argument. When silver prices rise, mining becomes more profitable. More silver gets produced. More production puts a ceiling on price. Silver is an industrial commodity. It responds to price signals the way commodities do. Unlike gold, there is no central bank bid, no reserve asset designation. Remove the sovereign demand floor and add a supply response, and the ratio compression thesis starts to look more fragile. Here is why that argument fails when tested against actual data. Silver has been running a structural supply deficit for 5 consecutive years. Prices have roughly quadrupled from their cycle lows. The deficit has not closed. It has widened. Refineries are operating at or near capacity. Industrial demand from solar manufacturing, semiconductor fabrication, and defense electronics is growing faster than the mining industry can respond to. The reason the supply response is slow is not theoretical, it is mechanical. Bringing a new silver mine from discovery to first production takes 7 to 10 years in the current permitting environment. Expanding existing production at established mines takes 3 to 5 years minimum. No price signal can accelerate a permitting timeline. No investor enthusiasm speeds up the geological reality of developing an underground mine. The supply response that the bear argument depends on exists in theory, but arrives far too slowly to matter in any time frame relevant to the current setup. The higher prices have been in place for years now. If the supply response were going to contain this deficit, you would already be seeing it in the data. Instead, delivery volumes are rising and registered inventory is falling. The deficit is not responding to price. The second counterargument is the monetary argument. Central banks buy gold, they do not buy silver. Without the sovereign bid, silver cannot sustain the kind of repricing that gold achieves. It is an industrial metal with a speculative premium layered on top of fundamentals that eventually revert. This argument has surface validity, but fails under examination. Silver was added to the United States critical minerals list. That is not a monetary designation, but it is a strategic one. In the current geopolitical environment, a critical minerals classification means governments are treating silver as essential national infrastructure. You cannot build next-generation defense electronics, renewable energy systems, or advanced medical devices without silver. That industrial demand floor is not dependent on any central bank policy, and it cannot be switched off by a change in monetary doctrine. But the more powerful point is this: central banks have not bought silver yet. The absence of sovereign buying today is not evidence that it cannot happen. It is simply the current state of play. What happens to the gold to silver ratio on the day the first major central bank announces silver reserve holdings? The absence of that catalyst today does not make silver bearish. It means there is a potential upside event that the current price does not reflect at all. I want to be honest about the risk scenarios that could break this thesis rather than only presenting the case for the move. First, if the Federal Reserve maintains a restrictive policy stance for longer than the market currently expects and the dollar index holds strength, every precious metals move gets capped. Dollar strength has been the recurring mechanism that has interrupted the compression throughout this cycle. This does not change the eventual direction, but it can delay it significantly, and delay has its own cost. Second, a severe global liquidity event, a credit crisis, or a forced institutional deleveraging across all asset classes could produce a short-term flush in silver, even with the long-term thesis entirely intact. We saw this in 2020 when silver dropped sharply before recovering and ultimately making new highs. If you are holding physical silver, the flush is a temporary pain. If you are leveraged, it can end your position before the thesis plays out. Size accordingly. Third, a breakthrough in viable silver substitutes for the industrial applications that drive demand, particularly in high-frequency electronics and photovoltaics, would remove the industrial demand pillar. I do not see credible evidence this is achievable within the next several years, but it is the honest risk to name. With those risks clearly stated, here is the summary of where I stand. The ratio is being compressed by physical forces, not just chart geometry. The COMEX delivery data is the mechanism. The short position reductions are the institutional confirmation. The gold advance pattern provides the numerator targets, and the convergence of two 15-year trend lines is the timing signal. All four inputs are pointing in the same direction at the same time. My base case is silver at $150 as the first major target, driven by gold reaching $6,000 and the ratio contracting to 40. My moderate case is silver at $280, gold at $7,000, ratio at 25. My upside case is $350 or higher if gold overshoots and the ratio approaches its historical extremes. Let me put those targets in terms that actually make the magnitude land. Silver is at $86 today. If you hold 100 ounces, that position is worth approximately $8,600. At $150, those same 100 ounces are worth $15,000. At 280, they are worth $28,000. At $350, they are worth $35,000. The same metal, the same ounces, just the ratio completing a repricing that it has completed in every comparable cycle in the past century. Scale that to 500 ounces or 1,000 ounces and apply the same math. The numbers stop looking like market moves and start looking like life-changing outcomes for anyone positioned before the compression accelerates. Let me add the historical anchor that gives those targets a grounding in precedent rather than just forward projection. In 1980, silver reached $50 per ounce. Adjusted for the full monetary debasement that has occurred since then, that $50 represents over $200 in today's purchasing power. And that move occurred in a market with a smaller supply deficit than today, a fraction of today's industrial demand, and a less extreme monetary debasement backdrop. The conditions in 1980 that drove silver to an inflation-adjusted equivalent of over $200 were structurally weaker than the conditions in place right now. My conservative target of $150 falls below the inflation-adjusted equivalent of the 1980 peak. If the most dramatic silver move in modern history, driven by two individuals attempting a deliberate corner of the market, produces an inflation-adjusted outcome that sits below my base case target, then I am not being aggressive with these numbers. I may actually be understating them. The final piece I want to give you is the resistance map so that you know what normal looks like on the way up and do not misread a pause as a reversal. The first major resistance zone is $100 to $105. Silver has never sustained trade above $100 in its history. When it gets there for the first time, the psychological weight of that level will produce real selling. Profit taking will be significant. Media coverage will be intense. That pause is not a failure. It is the market processing a historic threshold. Give it time. The second resistance zone is $110 to $115. That is where the prior rally stalled before silver made its push to the all-time high of $121. Sellers who entered near that peak and have been waiting for an exit at break-even will be concentrated there. The market needs to absorb that supply before it can continue. Once silver clears $105 and breaks decisively through the all-time high at $121, the character of the move changes completely. Above an all-time high, there are no bag holders, no previous buyers waiting to get out at break-even, no overhead supply structure. The path is open. In every commodity that has broken into open air above a multi-year base, the move that follows is not gradual. Price discovery in open air runs fast. My expectation is a direct move from the all-time high zone toward the $140 to $150 range where the first ratio target sits. Consolidation at that level. Then the second leg toward $280 begins as the ratio continues compressing toward 25. The roadmap is $86 to $100, pause, $100 to $115, pause, break the all-time high parabolic move to $150, consolidation, then the real run to $280 and beyond. That is the setup. That is the math. And every component of it is sitting in alignment right now. If you have been watching silver without fully understanding why the ratio matters more than the spot price, I hope this breakdown changed that. The ratio is the scorecard. It tells you where silver is in the cycle relative to where it has been and where it has always gone. Right now it is telling you something very specific. The second phase has not started yet, and when it does, the move will not look like what came before it. It will be faster, larger, and more extreme than most participants are positioned for. Drop a comment and give me your ratio target. Do you think the compression stalls at 40, or does it run all the way to 25 in a single cycle leg? Tell me what you think changes the timeline. I read every comment and I will pin the best analysis from both sides. If this is your first time here, this is what this channel does. Ratio mechanics, delivery data, vault inventory, short position tracking, every video goes this deep. Subscribe and hit the bell so you do not miss the next breakdown. The setup has been building for 15 years. Two trend lines are converging. The vaults are draining. The shorts are retreating. The physical and the chart are aligned. The wall is cracking.